Okay, some headlines from the world of business right now. The central bank in Sweden today decided to leave interest rates unchanged. It's been another day of a heavy one for commodities. Oil is back in the green. Stocks are also back in the green in Europe. Pre-open on Wall Street looking green. However, metal prices are taking a little bit of a rebound. Mining, energy stocks, all riding, roller coasting expectations of what the U.S. Central Bank will decide in the next 24 hours from now. So bearing any last-minute change of heart, Janet Yellen sitting at the head of the table in the room, the U.S. Central Bank will raise its interest rate for the first time in almost 10 years. Now let's take a look at this report, and look at what's been going on ahead of that decision. Let's see how the markets are bracing up to December the 16th. Today is still the 15th anyway.
After years of waiting, it's finally here. It's called the Fed Week. Analysts agree that the Federal Reserve will raise U.S. interest rates on December 16 for the first time since June 2006.
Certainly much anticipated, much hyped. The expectations that we have are that they will move away from the zero interest rate policy, that we will see our first rate increase of the cycle. You know, we do think that the initial increase will be 0.25%. That it will be the first of a series. However, we are not expecting those increases to be consecutive, and we'd expect them to be very data dependent. As we look through 2016, our expectation would be that we'll see a further 3 tightenings during the course of the year, perhaps 4 if conditions warrant.
Wall Street do not expect much U.S. profits acceleration. The Fed's words will create sharp rotations in and out of sectors influenced by interest rates. This phenomenon is expected to continue in 2016.
You know, about an 80% chance right now that they're going to hike rates, but then really hold off, in my opinion, for some time to come. And so the U.S., fighting this global trend of monetary accommodation and really, trying to save face, in my opinion, for the Fed and really having to move at least the initial amount before year end.
It has been so long since the Federal Reserve raised interest rates that U.S. stock markets investors probably should not look to past rate hike cycles for clues about potential winners and losers.
It is a major regime change. The Fed hasn't tightened in a long time. Historically, when the Fed tightens slowly, stocks manage just fine. They're up about 9%. When the Fed tightens more quickly, you see mild declines. But I'm not sure that history is the best indicator. We're coming off the zero bound for one thing. In addition, we think this tightening cycle is going to be, extremely gradual. Still, a real lack of inflation, some disinflationary pressures. We see that exacerbated with what's going on in energy. I think the U.S. market is probably going to be choppier, but gradual Fed tightening is not a death knell for U.S. equities. But what's more encouraging is if we look historically at how European equities have performed, emerging market equities. They've all done much better than U.S. equities in the 12 months after a Fed tightening, which makes sense because obviously they're a little bit more removed from the central bank's actions in this country.
In 2014, the low interest rate environment boosted groups that paid high dividends, and sectors such as utilities and real estate enjoyed gains of more than 20%. Those sectors had it rougher in 2015, with volatility increasing as a possible Fed rate hike started to dominate markets discussion. But investors do expect more rapid-fire moves from one stock market sector to another based on what happened throughout 2015 when comments from Janet Yellen or other Fed officials changed expectations of central bank moves multiple times.
From North America, let's step into South America, where Argentina's new president, Mauricio Macri, says he's eliminating Argentina's export tax on industrial goods as part of a surge of policy measures during his first week in office, designed to kickstart the stagnant Latin American economy. Although he lacks a majority in Congress, President Macri will be able to eliminate the export taxes without having to ask lawmakers for approval.
Mauricio Macri announced the move while speaking at a conference for Argentina's Industrial Union. Macri also wants to win back confidence in Latin America's third-largest economy in order to increase much-needed investment. The government sees a revamp of the country's much-maligned statistics office as a step forward.
Now I would like to announce to you all what I did this morning in the farming sector. Here we need to reward those who are motivated by the challenge of exporting, investing and innovating. This is why from today there will no longer be taxes on industrial exports in Argentina because it is not appropriate.
For years, data produced by the INDEC office has been broadly seen as inaccurate and politically motivated. Consumer price data in particular has shown inflation about half the rate estimated privately. Critics say the government massaged the data to reduce payments on its inflation-indexed debts and rein in inflation expectations. INDEC Director Judge Tedesca set out his objectives under Macri's administration.
The immediate objective is to re-establish the public service of statistics in Argentina. That is the immediate objective. Public information is a constitutional right, which is increasingly regarded as a universal human right, and this is a public service.
Macri's victory ended 12 years of Peronist rule, and the incoming government has sought to strike a different chord from predecessor Cristina Fernandez. The new president has pledged to correct the errors of the outgoing leftist Peronist government. He called capital controls a mistake and said his government would restore the central bank's independence and overhaul national statistics. Antonio Carlo from Argentina's General Workers' Confederation said his union will push for a deal with the new government that benefits employees.
With the social pact or social agreement, whatever they want to call it, will it benefit the workers? I don't think there is any trade union director who will deny this, and if it is not beneficial to workers, well, we'll discuss this at the table until the parties reach an agreement.
In ending more than a decade of Peronist party rule, Macri becomes only the third non-Peronist leader since the end of military rule in 1983. The other two failed to finish their terms, a reminder of the difficulties that Peronist labor unions, state governors, and opponents in Congress could cause Macri if he is unable to get the economy growing quickly.
Back in Africa, e-payment is expanding across the continent, and Egypt now has the largest e-payment network called Fori that has been injected with $100 million by a consortium of 3 international financial investors. Fori is an Arabic word for immediate in English. It allows customers to pay bills through 50,000 service points in small groceries, pharmacies, stationers, and post offices across the largest economy in North Africa. We're back after the break. We'll talk about the world of oil rebounding. Today, 1.2% for U.S. crude. How sweet is the oil prices? We'll talk about that. We'll talk about oil in just about minutes, but just hold on a little bit. The World Trade Organization's Ministerial Conference for 2015 is currently underway now in Nairobi, the Kenyan capital. Hundreds of delegates around the world, almost 200 countries are attending this very important conference taking place for the first time on the African continent, starting today and ends on the 18th, towards the end of the week. Global trade flows will be the key discussion. Kenya hosting that conference will bring Africa into sharp focus at the 4-day event. And just as we're getting on air, early hours in the U.S., close to 8 o'clock in the morning, Moody's ratings have revised downwards its oil price forecast for 2016. That revision came in today down by 17%. Early today, we've seen oil at $35 a barrel, slightly up by 2% where we were since the start of the week. Let's bring in Kodili Nduka, who is a research analyst talking oil with us from downtown Lagos Financial Derivatives Company. Kodili, thank you very much for finding time to be here.
Good afternoon, Blessing.
Okay, just about as we started, and everybody's looking really, really happy that, well, perhaps we're seeing oil prices heading north. Moody's ratings just came in and said, look, we're revising our own oil price outlook down by 17% for 2016. What does this tell you about the volatility and lack of stability in oil prices moving into the new year?
Well, I can say that this is actually the period for, should I say, for forecasting, because this is the end of the year, so different people are going to come up with their forecasts for 2016. Not surprised that Moody's has come with theirs as well, and it just shows you the, should I say, uncertainty sort of going into 2016. While we're hopeful that things are going better, it doesn't really look likely. On Friday, the IEA also came out with its own forecast saying that it thinks the global glut is going to continue into 2016, and it's even going to last till late 2016. Previously, we thought it was just going to be the first part of 2016, but now the IEA is saying it's going to probably the end of 2016, and so that Iran comes into the market if the sanctions, Western sanctions, are removed. Then you also have OPEC insisting on pushing out more oil into the market, despite the fact some of its members are not really benefiting from this. They are suffering budget deficits and all falling in reserves. So if continues, and then the U.S. shale producers, I mean, they are also unrelenting. I mean, despite the fact that oil prices have come down by at least 5%, they are still pushing out oil. So while we expect that in 2016 stockpiles might actually decrease and the non-OPEC supply might actually increase because of these low prices. For what we have left, and with Iran coming into the market and OPEC as well, we'll still keep prices low in the meantime.
Okay, accordingly, we have just about 1 minute, so let's bring it home. There are quite a lot of issues to chew around this, but do you share the optimism of the NNPC chief executive, the group managing director, who says, well, he believes the $38 a barrel for 2016 budget for Nigeria will be okay? He believes that, well, those revisions to the upside that oil will rebound in January 2016, and perhaps as we go into 2017, we'll see $50, perhaps $70 a barrel. Does that look like a feasible scenario?
Sorry, are you talking about the benchmark oil price?
Very correct.
Very correct. So the thing with the benchmark is it kind of provides a guidance as to what they expect oil prices will be or what they are going to sell our oil, that's in 2016. But at the same time, you also don't want to put it at exactly price oil is going to be, so that you give room for some savings. But I guess the makers, they want to maximize as much from whatever they're getting, the revenue they're getting from sales, because they already think revenues are low and it's not enough to support all they have to do. So that's why they need to be higher, to be closer to what we think oil price is going to be in 2016. But the government want to make room for some savings so you can put it into the ECA. But the thing is, it's not just the benchmark price that you have to look at. You also have to look at production as well, because even if your price is 40 or is at 50, if production is not good enough, because revenue is a function of both price and production. So even if your price is at 40, is at 50, but your price is lower to 1 million barrels per day, or even lower than that, you won't get as much revenue as you want. They also have to focus. I think they also have to focus on the production side to boosting production, make sure it gets up 2.2 that they are targeting, or even more.
Okay, let's leave it at that for today. Kodilin Duka, a research analyst at Financial Derivatives Company Limited in Lagos. We thank you for your time this afternoon. And do have a great day, everyone, whatever you're doing for the rest of the day. I'll see you next time. I am Bosin Amafaye, and see you later.